Hello, my name's Peter Young, and this is the second of a three-part series of interviews I'm conducting on a book called The Zero Interest Trap. I'm joined today by one of the book's co-authors, Rahim Taghizadegan, who is the director of the Institute Scholarium, which is an Austrian economics-focused think tank based in Vienna. And he's also director of the Free Private Cities Institute in Switzerland and lectures at universities around Europe. So today's discussion with Rahim is going to focus on some of the cultural and social aspects of this phenomenon of zero interest rates. So Rahim, it's really great to have you today for the conversation.
Great to talk to you. Greetings from Vienna.
Great. So I want to start off by talking about this concept of 0% interest rates, because to most people, this might seem like quite an academic area of focus. It's something that maybe applies to finance, but they don't really see how having low interest rates affects broader things about society and about culture. So can you just explain to us why interest rates are so important for economic relations, and also why having a 0% interest rate is something that is quite peculiar and has particular societal implications?
Yeah, most people generally underestimate the importance of exchange between foreigners for our modern miracle of wealth, I'd say. And it's not only the exchange of ideas and knowledge, but of course, everyone can see the exchange of goods. But as important, maybe even more important, is the exchange in time of assets. So interest rate is a price attached to this kind of intertemporal exchange. And I think it's hugely underestimated. I think it's even more important than the exchange of physical goods in space. And that's because that's what we can see. And what we can't see is disincentives to learning, so something that may affect knowledge creation and division of knowledge in the long term, and disincentives to capital formation. Because both the division of knowledge and the division and this kind of collaboration, capital formation, have huge leverage. I think it's really a bad idea to underestimate the long-term impact of those two kinds of exchange. And as I said, interest is a price, so it's necessary for economic calculation. It gives a kind of rationality, of course, always taking into account the uncertainty of the future. It gives a certain kind of rationality to economic interaction, and in particular collaboration among foreigners. And if a price does not reflect the outcome of human action, of a base as broad as possible of human beings and the preferences, of course, there's always the danger that we have economic processes and structures that are not aligned with the long-term preferences and interests of most participants. And that doesn't only have political implications, but also, of course, we measure wealth in the long term, how well aligned the production of goods and services is with our preferences. Otherwise, it wouldn't make sense to even have the concept of wealth, because there's nothing inherently objective about this. It's really fulfilling our ends and finding means for our ends. And I think those long-term effects tend to be overlooked. And that's why interest rates are that important.
So how is it even possible that we have zero interest rates at the moment? Because just looking at it, it seems like quite an absurd proposition. If you give me the option of having an Apple today or an Apple in 1 year, or a computer today or a computer in 6 months, I'm generally going to prefer to have the thing sooner rather than later. But what interest rates of 0% effectively imply is that those things are all given an equal valuation. So how is this whole situation where we have 0% interest rates on the market come about in the first place?
I mean, you can point at the paradoxon that people in their voluntary choices seem to be willing to buy government bonds at low to zero or even real negative interest rates. But that's only the thing you can see. What you can't see is the massive crowding out effect that's happening. So without this kind of base money creation of central banks and the whole complicated cartelized structure of our financial system, we wouldn't see this kind of pegs between different kinds of money. And I'm pretty sure we would see interest rates that more closely reflect the preferences of the population. And of course, it could be possible that really the preferences of the population tend towards very, very low time preference, infinitely low time preference. So it's nothing that you can totally rule out, but I think it's a very theoretic proposition, very unlikely, and that's due to human nature, and that's due to the nature of our world. There'll always be uncertainty in the future, and we'll always have a need to survive in the present. So I think time preference would generally be above zero, and in particular if you have exchange between foreigners. So that may seem like the appeal of very low and zero interest rates. They can be symptoms of some profoundly good things. If, for example, you treated people like your brothers and not as foreigners anymore, and you really cared for their ends as much as you care about your ends, you could expose in your behavior a preference for close to zero interest rates. And that's, I think, the reason why most major religions are in favor of zero or low interest rates. And I think it's a kind of veneer of moral appeal of the current situation. But of course, if it's not, and I think that's what you have to ask yourself, consider yourself and the people around you, do you really believe that it's the correct representation economics of the preferences? And I think you'd rather quickly realize that, oh no, there seems to be some unconscious, very high time preference going on. And you can see that in a lot of aspects in our society. And then, of course, the economically sound conclusion would be that those kind of interest rates are misaligned or a mismatch to actual preferences of most economic participants. And that, of course, we know it's a kind of impact that you have of price controls, and any kind of intervention in those processes necessary for economic calculation, that this kind of mismatch can have in the long term very bad outcomes, surprisingly bad outcomes.
Mm-hmm. Yeah, that's an interesting point. It feels instinctively like there's something out of kilter when there's lots of kind of circumstantial evidence that people's time preferences are quite high. You talk a bit about this in the book. Lots of the dominant businesses are focused on gaining the attention of people with short attention spans. And we're seeing more and more focus on kind of immediate consumption rather than thinking about the long term and investing in projects which have a longer time horizon, rather than things that are likely to deliver a quick exit for venture capitalists. So that was one of the things I enjoyed in the book. And you also gave this kind of analogy about why it is that interest rates are low. And you said that it was kind of like setting a maximum price through price fixing on a good. And there was this analogy with bread, saying that if you give a maximum price to bread, then that doesn't mean that bread becomes more available. It just means that the bakers stop producing the bread because they don't have sufficient profit incentive to do so. And the bread disappears from the market, and the bread inevitably becomes more scarce. And you kind of liken that to interest rates and said that because people aren't being paid sufficiently for their savings, people end up consuming rather than putting aside real savings that can fund genuine productive investment. So can you talk a little bit about that phenomenon of kind of a maximum price? How is it that the central banks can set this maximum price for interest rates? And what's the real impact of that in terms of impacting productivity of business?
Yeah, I think it's really quite complicated, because obviously it's not a direct price setting, but the effect is very similar to it. So with this very complicated structure, what you actually have, of course, you always have disincentives for this kind of, I think, the basic form of saving, which is trying to preserve the liquidity of your income which you can gain as long as you're able and young and able to produce income and transform it into wealth, which you'll use in old age. And it's the most basic form of saving, and it's a general human need to do so. And now if you can't do that in the money you use for transactions, or you have a disincentive to do that in the money you use for transaction, this phenomenon does not appear because it's rooted in human nature and the logic of human interaction. So it just shifts to other assets. So other assets become artificially monetized, I would say. But the problem is it's assets that are inferior from the monetary aspect. So we see a lot of monetization of government bonds, I'd say, of real estate, and any kind of asset you can think of, basically. So there's a kind of artificial monetization of actually inferior monetary goods. So you just have a shift, and this inefficiency alone is part of this misallocation. You have a disincentive to provide direct liquidity to create cash flows. So because then you would go for businesses that produce cash flows. And that's what the traditional instrument of bills of exchange, for example, was used for. So you can use ongoing cash generating businesses and you acquire part of the ownership in that. Of course, that takes some entrepreneurial judgment. So in the past, you had banks specializing in finding out the liquidity of those bills of exchange. What nowadays happens is that savers are pushed into being investors, and that's another part of the misallocation happening. Now they are pushed because they are conservative in general sense, because the basic need for savings is to preserve. They just want to preserve, usually. If you're a typical wage earning person, you want to preserve that liquidity, and that means spending power. So they go for bonds, and bonds are increasingly monetized, and that means, of course, there's a monetary premium on bonds, which lowers their yield tremendously. So you're willing to spend more and more just for having those bonds. And why are you spending more on having those bonds? Because you compare them to the bank assets you may have. So you have less bank risk and risk of failure of a bank if you keep a government bond. So I think it's part of that artificially pushed monetization, plus not even that would be sufficient nowadays. And now you have a quantitative easing for quite a while, since the great financial crisis in 2007 and 8, a lot of direct monetization via central banks. And what it does is, of course, it keeps a kind of peg between government bonds and fiat money, cash, and so on. It keeps it artificially stable. Otherwise, I think, of course, you would have seen different prices and even dropping prices for government bonds. One of the best performing assets in the last year or the year before was Austrian government bonds. And that wouldn't make any sense in a kind of a rational economic environment. It only makes sense to do that pushing of this basic need for hoarding into other assets. So you have a lot of the impacts, but you see, I'm talking on and on. It's a very complicated structure. It's really hard to look through how it can work out like price control and the price ceiling. It's more or less, it's intervention whenever movements would go into higher interest rates, triggering higher interest rates. So you have massive intervention, and the bakery example would be someone just throwing fake bread on the market whenever it looks like rationing is happening and the shortage is happening, to push that further in the future, and thus have this ongoing structure of disincentives for the production of bread. And in this case of interest rates, is disincentives for capital formation. Capital formation happening out of hoarding liquidity. And of course, this liquidity is an overlooked part of even productive capital, because you can't have productive long-term investments without choosing the time of your investment and without having a liquidity at the correct time of your investment. Otherwise, you'd always have these short-term tiny part stuff investments where you buy fractional shares in something that's just hyped on Reddit and so on. And I think there are plenty of reasons why the impact is very similar to price controls, but you don't see it immediately. You can see some rationing in the aspect that most banks wouldn't give you a credit if you need one. So in Austria, we'll give you very low interest rates and you can get huge credits, but only if you really don't need it. If you're a business which would really need that kind of capital, it wouldn't be capital, this debt infusion to expand its business, you wouldn't get the credit. So if you already have real estate, you can use that to leverage into more real estate. If you already have a cash producing business, for tax reasons, more or less, you take out more credit. And so I think it's this kind of rationing where banks are shifting from providing the credit to those that would really use it productively.
Mm. So isn't the counter argument to that, though, that if we have non-inflationary money and we have positive interest rates, then people can just do what you've described. They can take their money, put it in the bank, and they can save it for their retirement and they can receive a stable return. But as you've mentioned, that means that they don't have to make that investment decision. They don't have to look for productive things to deploy their capital in. Yeah. So couldn't you argue that the fact that this system of inflationary money and suppressed interest rates is actually good for the economy because it spurs new investment?
Mm-hmm. Yes, that's in a certain sense true. It's good for the visible part of the economy. So things that are obvious at the moment and are potentially generating returns, of course, you'd have more money going into that. And the impact or the effect of it in the long term is that the marginal productivity of credit created money goes down a lot. And at a certain time, of course, it reaches very, very low levels. And of course, there's a kind of backing that goes hand in hand, low marginal productivity with low interest rates. But I think this low marginal productivity lies in the hidden aspects of the economy. And that's the kind of technology formation, innovative uses, which always in the present tense look like foolish investments, only something which someone which would invest in, who would say, okay, that's my money, I put it on the side, I've been saving my life, and okay, it's I take that kind of risk. And a lot of investment isn't really just for a short-term profit. It's you are really passionate about something, and because you always have the opportunity costs. You're offering up some of the liquidity you build up, so you usually you go for some things that you're really passionate about, or you have some inside knowledge because maybe you're an engineer in a technological field and you see something due to your alertness which everyone else overlooks. And it's these kind of investments that disappear. So more and more investment looks like leveraged, boring kind of investments. In Austria, is mostly real estate investments, and it's extremely boring. Of course, there's some innovative entrepreneurship in real estate, but almost everyone who has money in Austria is in real estate. And apart from the hidden champions, as we call them, so the remainder of those industries that are still fairly strong because they make best use of the human capital that's here in Western Europe. Yeah, but I think what's overlooked is that investment, of course, you can have this entrepreneurial part of it. And I think it's very personal, subjective insights which you use for, and they don't work well if you have this committee kind decision making, if you have a political decision making, if you have huge corporations. So I think in the long run, entrepreneurship happens out of people who maybe overestimate their personal insights, but still are able to take those risks, are able to appear foolish. And the only way that makes you able to appear foolish is a kind of liquidity that you put on the side, which you can call fuck you money. It's a vulgar way of calling it, but I like the idea of it. And I see that behavior with many people who have been able, but due to investments, of course, and it's much more complicated, and a lot of hardworking and thrifty people really are missing out on that. Because they tend to be conservative in their savings. And I think that's the huge loss. It's like really hardworking, thrifty, ingenious people who don't have enough liquidity, and they would maybe become investors, because if they had a kind of stable asset, which maybe due to a network effect even takes away the amount of thinking that goes into it. It's like the asset most people go into, and that's real estate in Austria, I'd say. But I think it's a really inefficient kind of monetized asset, because of course it's something we need for housing. So there's a lot of this monetary demand for it, and it's not really fungible, it's not really divisible. It's really, really bad from a monetary point of view. And so I think in the long run, it decreases this kind of innovative investments, which really need to push the boundary of technology, be a pioneer in a field that really go, like Peter Thiel calls it, the 0 to 1 kind of investment. And that's what's missed. And because it's invisible, it's something you can't see. It's like a future that doesn't exist.
Mm. So because the main function of money as a stable long-term store of value is being taken away, you're sort of seeing monetization of different kinds of assets in the economy, like real estate, like bonds, like stocks, and people are using these to perform the function of money. But you're saying that that's taking capital from places where it's best used and kind of channeling it into these less productive types of investments, just because they're viewed as more stable and less risky. Whereas if you had that basis where everyone could save in the currency, then they'd be able to make a more conscious decision about the riskier but potentially higher return investments. And we'd see more investment going into those more valuable 0 to 1 type
Yes,
deals.
and you'd have more specialization. I mean, people are basically pushed into assets like stocks and bonds and real estate and so on, because it looks like the most conservative thing you can do. And I think one of the most conservative investments, which we don't have that much in Austria due to a lack of culture, is technology stocks. It's the funk stocks in the US. I think nowadays is the most conservative investment you can do, to have an ETF in technology stocks, which of course shows you a bit the absurdity of it. And then if you use that real measurement as a denominator, I'd say, and look at your dollar as other dollar assets, and you denominate it in funk stocks, if my hypothesis is correct, that they tend to be the most conservative kind of investment, because due to these networks effects. Now, conservative means you don't take risks. You go where everyone else is going, more or less, and you hope that it has kind of stability, because there's something underlying it which gives some reason to these kind of network effects. So if you express that, you see how immensely impoverished most Americans have become. And I'm just looking, not taking them as an exception, if they express their wealth in funk stocks. And that just means an ownership in the most productive means of production in their national economy. And if you look at it this way, you say, okay, there's an immense redistribution going on. It's an immense redistribution from savers who think that they are conservative, but are actually misled and pushed into the wrong assets because they feel, something about technology stocks must be entrepreneurial, or even you feel reluctant to invest in real estate because you say, I know there's some active part to it. You got to find someone who rents it. You got to fix the things and so on. There are risks implied. And I think it's absolutely true. It's an entrepreneurial business. It's a great business if you know it, if you love it. It's a fantastic business to be in real estate as an innovative entrepreneur, but not as a passive hoarding investor. I think that's a sign of misallocation and misalignment and disincentives to learning. So it's really a waste. It's a waste of energy, money, ingenuity, creativity, and waste is something that's hidden. And only in long term, you see the impact and effects. And I think we'll see that. And I think if you really look at it, you can already see in some societies these kind of long-term impacts of the misallocation.
So I guess it's one thing to misallocate resources in a sort of opportunity cost sense, like you're not investing in the thing that yields the greatest social return. But in the book, you talk about the concept of the capital consuming entrepreneur. So the idea is that actually by taking capital, the entrepreneur is not only not investing it to its full potential, but it's also kind of consuming capital, reducing the societal capital stock. So can you talk a little bit about that concept and why that is more prominent when you have 0% interest rates?
Yeah, as like telling a saver that he needs to become an investor is as cynical as telling someone who can't get a job right now that he should become an entrepreneur. And the fallacy about this is that entrepreneurship is a great thing, but it really is a very specialized thing. It's for people with particular alertness, tolerance to frustration, and really there's some characteristics behind it. And of course, there's the economic function. They are promoted, which means they take skin in the game in shifting production factors, and the likelihood is usually lower than 50%. It's like it's more probable to waste resources if you go entrepreneurship, because if you are successful, it means most other entrepreneurs and investors have missed it. So you found something everyone else is missing. And if you have the impression that you see something everyone else is missing, the likelihood is very high that it's actually you seeing something that's not there, because you just don't know the industry. You don't know the cost of it. You don't know what goes into, what kind of knowledge, what kind of preferences, what kind of real demonstrated preferences people would reveal if you confront them with an offer, and so on. So it's a huge learning experience, and most successful enterprises pivot during their time of formation. So they learn on the market. They tend to be flexible, and it's a kind of character set, I'd say. So if we now look at this as the common, most conservative measurement rod, and look at this kind of high scaling startup entrepreneurship as something where everyone could go and have the American dream in the end, I think it'll lead to massive misallocation, and that's capital consumption. If you take the means of production and putting into worse uses, and you only find out in the long term, because then you realize, oh my God, people aren't really willing to pay for that, and the cost is higher in the long term than I thought, and the costs are going up in exactly the parts that I would need, because I haven't figured in that everyone is going in the field, so the means of production needed for it will increase faster than the returns on them, and so on. And that, of course, is waste. That's why entrepreneurship is not a means in it, not an end in itself. It's a means to something. It's a means to shift the production structure from a worse, long-term worse alignment to the preferences of the population to better alignment of the preferences, and that brings with it a lot of uncertainty bearing that you need to be able and willing to do. And most are not, and that's fine. I think a lot of the division of labor relies on people not just doing something different, but doing something well. And you can have a lot of success in your career if you just do something. A lot of other people are doing it, but do it with passion and do it with drive, and do it consistently over a long time. And I think that's overlooked, and it tends to be overlooked in this kind of short-termism, which now I think it's a cynical answer. Say, okay, it's getting more and more difficult to find a job, so just become an entrepreneur and maybe just do some kind of venture financing early on. And in Austria, it means just fill out a government form so you get your company financed. And it boils more and more down to that. And those companies, of course, most of them fail after the government subsidy ends. And then, it's obvious misallocation of capital, and it's only the visible thing. And I think the invisible thing is even worse. It's like really creative, intelligent people spending their time on filling out forms and convincing some investors, which are basically either government employees, corporate guys, bankers, and so on, who have no idea whatsoever about the industry they are looking at. And that, I think, is this kind of waste, tremendous waste, which we don't see, but in the long term have to bear the price of that.
So rather than having a dynamic where entrepreneurs specialize in their particular industry, understand what the profitable ventures might be, and take the risks themselves, you have this kind of bureaucratization of business, and businesses shifting to kinds of activities that are not directly meeting the needs of consumers, but are more focused on meeting the needs of bureaucrats. Can you talk a little bit about how this whole phenomenon has a wider cultural impact over the longer term? How is it that when you see this shift in the focus of intelligent people in society from serving the market towards kind of box ticking and form filling, how does that impact on the broader social culture?
Mm-hmm. Where we already see that with more and more young people tending or opting for a government job in Western Europe. Now, I bring up a lot of these Western European, Austrian examples as something where we are a bit further ahead in the role of government that government plays, and in particular now to the pandemic, it's like limitless government intervention. But it's really just an increase in the speed of this kind of development. Once you have discovered monetary policy as a means to replace fiscal policy, there really isn't a limit to it. So I think a lot of it can be learned from this experience already, where of course we have a high enough level of wealth and hidden capital where we can still bear this kind of misallocation and still have a quite wealthy and comfortable life. But the sustainability becomes more and more questionable. And you see that, I see that every day with really like the brightest people shifting careers, changing to the safer bets, or if it's seemingly safer bets. You have to look at what young people are going for. And either they become very entrepreneurial, in a sense, pushed into entrepreneurship, which is a kind of global entrepreneurship, dreaming of creating the next startup, or just going away, being a nomad entrepreneur. This kind of digital entrepreneurship is a lot on the rise in Europe, and just really people just moving away and to other jurisdictions, or going for a safe bet. And what I'm really afraid of is that the middle disappears, and the middle is this kind of productive people seeking a stable environment where they can raise their families, be productive, do something really well over a long term. And this we have seen, I think, disappear in Japan as well. And so Japan and I think Western Europe are some examples where you can see the very wealthy and capital-rich societies. And that means that the impact is not seen immediately, but where you can observe the long-term effects the best. And that's why in our book, we look so much at the unlikely signs of those shifts happening. That's why we write so much about cultural indicators and behavioral indicators and so on, which just give you an impression where that could lead and where it's turning. Yeah, your question again was how does the misallocation, how does it show itself? And
yeah, culturally, how does it manifest itself on society in that way?
I think it's really it's behind this polarization that's going on. It's between extremes, and the middle disappears in many fields. It's the middle in in investment, it's the middle in entrepreneurship, it's the middle class, more or less, or the middle class lifestyles, and you have the extremes, and you have the same polarization, of course, happening in politics, which is a lot of it is really the gap between the rural and the urban populations, and that's driven, and it's even leveraged by the Cantillon effect. That's the one of the directly distortionary impacts of monetary policy, which if you have a lot of reliance on the big structures, on the scale structures in government structures, that of course means a redistribution to the urban areas, but a lot of this kind of inflationary misallocations and distortions happening at the same time, and that pushes this kind of political polarizations, which is unconscious class conflicts, more or less, and unconscious understanding that the system isn't really working for you, and so on. A lot of unconscious underlying things that are happening here. So I think you can see these kind of polarizations. It's a polarization. Politics is a polarization in careers. It's a polarization in investment, and so on and so on.
Mm. So you mentioned there the example of Japan, and Japan's probably quite an interesting case study because they've had below 1% interest rates since the late 1990s. And for most of the time, it's been kind of around zero. And the deposit rate in Japan is now just below zero.
Yeah.
And so given that that's manifested itself in Japan for over 25 years, have we seen these sorts of effects that you're describing manifest themselves in Japanese society, or have they found ways to mitigate these damaging effects?
I think are pretty obvious signs in Japanese society, but it's always hard to look at societies with such different cultures, you know. So, of course, you need to have a link between economic explanation and potential causes and then distortions where you say, okay, it would still exist as a phenomenon, I think. I think there's nothing deterministic in economics. You really want to understand what kind of trends are potentially artificially inflated. So there's more of it than there would be. And I think you can see a lot of that in Japanese culture. I think that the hikikomori phenomenon of young, productive people retiring from production, not only the production of value, but also the production of kids and procreation. It's still, still the demography would be, that's an underlying effect. It's not that much related. It's not caused by monetary policy, but I think it's increased. And one of the reasons it's increased is you have this kind of shift. If you look at the savings of the Japanese, you still see nominally, they seem to have quite high savings on average. But then if you look at the composition and what it means in purchasing power, you realize, oh, wow, most people below 40 really haven't been able to build up savings, and then they get towards 50 and 60, and there's no sign that they'll be able to leverage that kind of build up of savings that maybe their parents and grandparents still could due to the monetization of the assets they had, like real estate, for example. And they are unable basically to provide for that kind of stable outlook in the future. And I think it's very rational once you unconsciously realize that the only way to do so is to follow the suit of your parents and grandparents. And that basically means is to work in a corporation, be very thrifty, and follow directions which, due to the disincentives to learnings and the zombifications and the scaling effects of zombification, tend to have less and less meaning. So it's a price where the price gets higher and higher, and the outcome is really ridiculous. Then if you look at what your parents were able to build up through the whole life, and still I think they are the most advantaged generation in Japanese history. So they have wealth, I think you see so many signs where old people in Japan, they go for asceticism. It's like they remain thrifty, they save a lot of their money. It's amazing savings rates, all-time high savings rates still, but no buildup of capital. And that, I think, is such an immense loss that everyone on the planet has borne, and no one sees it, or very few people see that. Imagine if Japanese engineers, who in the 80s were supposed to be the world leading, the best people on the planet, basically, to develop high tech, and there were even innovations in management and so on. It looked like the future's Japanese. And of those people who were really core of a revolution, where a culture like bloomed in a kind of high-tech development, where every one of us has been beneficiary of those kind of contribution, what they've ended up with. And you see there's no culture of investment is born out of it. Very few Japanese engineers who now in the 60s, 70s, 80s would say, I know the field, I have inside knowledge. Why wouldn't I use part of my liquidity to push that innovation, to create something new, to mentor young people, to give them, to help them, to push a young engineer into something where I can see the potential because I've been in the field and now I see a important tiny change in technology, which makes it possible, which was impossible before. I'm very sure without this kind of monetary distortion, we'd have, thanks to the Japanese, we would have flying cars, we would have space tourism, we would have so many health improvements because they have the challenges of aging as we do in Europe and most societies on the planet. And there's so much innovation we are missing out because what's the end of life for a Japanese is more or less this thrifty, meaningless, senseless living on a comfortable level, but really still being reduced, afraid to consume, afraid to take risks, just being happy that maybe if you're very lucky, you have a grandchild around, but usually not even that. So you focus on some cultural distractions, and you focus on this kind of physiology of just surviving, of eating well, maybe every now and then, but then you're afraid to, of course, go out too often because you have to be thrifty, you know that. Because the devaluation of your savings, of course, compared to the purchasing power you have. So even if you're an old, thrifty person and you have your average savings of $50,000 or something, still compared, I mean, it wouldn't provide you that kind of stability where you say, okay, now I can take risks, now I can travel the planet and see where I can fit, now I can improve Japan and the Japanese society, I can give back something. There is so little of that. Still, of course, there's a lot. So we see what's visible and we see the wealth, but it's a stagnating wealth. And I think it reflects in the culture where we have most innovation in Japan nowadays, which you can see if you walk through the malls in Asia and so on, where the Japanese are still strong is this kind of entertainment, short-term consumption, childlike, very childlike, I think, consumption patterns. And in Japan as well, a lot of things which, I mean, maybe culturally foreign to us, but still are very odd. This kind of platonic prostitution you have. So a lot of short-term substitute consumption happening for a life missed. I think there are signs of missing out on the full potential and meaningfulness of life and going for some quick fix, which you allow yourself maybe once a month. You go to your karaoke bar and later you hold the hand of a girl, which you know you'll never be able to start a family with, but you pay her to hold her hand and so on, and you fake it for an evening. And that's really, really sad, I say. And there's nothing against Japanese culture. It's from a respect for the potential of that culture. There's amazing contributions of the culture to the planet that I think is so sad about those invisible, unseen distortions to that path that was chosen and was copied, because it works so well in the short run, and it works so well politically, and it works so well for some people who, of course, are beneficiaries of those kind of zombified structures. And basically, of course, the boomer generation, corporate guys, no innovation, spend most of the time in meetings and think that they are like the great innovators of tomorrow, but actually they're living off the capital acquired in the past, and they're great wasters of the present, and wasting all that potential and capital and energy and creativity and so on.
Yeah, I think that's really important to think about it in that way, because often we just look at whether things are getting better or getting worse, and we don't think about the gap between the potential, the opportunity cost, and what is being achieved. So we see a country like Japan where I think it's still the case that things are getting gradually better. It's quite hard to argue that life in the 1990s was overall better than it is today, even though you haven't really seen very much real economic growth. No. But as you say, in the 1980s, it was widely thought that Japan was going to take over the world, and it was the leading kind of economic power. There were people studying not just Japanese technology, but studying Japanese management techniques and trying to master the secrets of this culture. And whilst Japan's retained a very important role in the global economy, it's very much kind of taking a backseat to countries like China, and feels like it's on more of a stagnating path. So it is important to think about not just the state of a society, but also where it is relative to where it could have been.
Yeah. Mm-hmm.
And in your discussion of Japan there, you mentioned a term, zombie companies. And that's the term I wanted to discuss with you, because we talked a bit earlier in the conversation about how people might end up investing in projects that otherwise they wouldn't have invested in, because there's no method of keeping your savings in a zero interest environment without undertaking some sort of investment. But there's also the phenomenon that if you're a business that already owns capital, and within that environment, people lower interest rates, so lower the value of your borrowing and lower the value of your debt, it makes it easier and easier for you to stay afloat even if you're not really delivering for society, even if you're not making real profits, you can still continue to make nominal profits in a zero interest environment. So can you tell us a bit more about the concept of zombie companies? I'm interested in kind of how that applies to the situation in Japan, but also more broadly, how it's starting to apply more to Europe and other places around the world, such as North America that you reference in the book.
Yeah, we have not invented the term a zombie company. It has become quite widely used as a really technical term, referring to companies that are only kept alive due to lower and lower interest rates, which means that profits wouldn't be sufficient unless they are able to refinance themselves to those surroundings. And I think we were able to explain the phenomenon on a lot of levels, and seeing that it's really just a symptom in the corporate world. You have very similar symptoms in other parts of society as well. And zombification refers to a kind of ossification. And most importantly, I think, it's disincentives to learn. Because you have artificially inflated better incentives to just keep on doing the same thing you've been doing, as long as you have the right connections, which usually now means that you're close to money creation. So you have the right connection, you know the right politicians, you know where, maybe even if you're a great insider, you have paid Janet Yellen a few $100,000 to speak at your event, and you get some like prophecy of where central banking policy would go and so on. And you can use that, and you have a scaling advantage. You have a leverage on these kind of connections, access to central bank created liquidity, and going, of course, through to the banking cartel. And that really is an incentive not to learn, not to change something. And we see the same in politics, where due to using monetary policy in replacement of fiscal policy, the cost of wrong decision is so further postponed into the future that you have basically no skin in the game. There's really no consequence whatsoever if you are destructive. Really, if you do something, if you make an intervention, you take a decision and it doesn't work out at all, what happens is you get more money, you get more funds, because it wasn't enough of it. Yeah. And that's why we have this kind of intervention spirals working in politics. And it's why we have this kind of sunk cost-led increase in structures in corporations, where they get fatter and fatter, and you can really tell why. You don't see that the marginal in productivity, the marginal innovation is going up. It's just they are too big to fail. And this too big to fail phenomenon, which I would say is too well connected to the leverage effects of money, of this kind of monetary policy, means a zombification. Means things are kept alive, which wouldn't be alive because life is changing and people are changing, and we need to learn. We need to be constantly learning, and that's what's great about our human potential. Is the dynamic aspect of it, is the capacity to learn and not to repeat the same errors again and again. And I think that's an overlooked part. It's really about, I think, knowledge in the long term and disincentives to learning. And that we only see in the very long term, but I think we can already see that it seems pretty obvious. It seems obvious in the handling of the pandemic. It seems obvious in so many interventions where really we don't even discuss it nowadays. You have a politician taking a decision, a manager taking a decision, and like 3 years later, 2 years later, obviously it was wrong. It was like in what he predicted, or he or she predicted, what he thought, she thought, what was the thought process behind it. And you can, if you looked at it, you could say, okay, that was wrong. What have we learned from that? Yeah, it's not that they're evil, just, okay, let's learn together, let's avoid it. But we don't even discuss that now, because 2 years ago, that's 2 years ago, who cares? We can't even remember. This is kind of short-termism. It doesn't matter anymore. You promise something, you won't deliver. It doesn't matter. You just go on, because it gets easier and easier. You just you have the best performing asset suddenly, and just by taking out new money, which is like, even you get an incentive to be wrong and to be boldly wrong, and just continue and leverage as much as possible this being wrong that you can, to just monopolize this access to the artificially increased liquidity.
So you mentioned there the idea of being wrong, but only manifesting itself in the long run. After a long period of time, societal behavior patterns start to change. People are incentivized to go more into kind of government focused areas, or areas that are related to the process of money creation, or into corporations that are already established and are able to exist longer than they would otherwise exist due to the infusion of cheap credit. So what do you think it's going to look like in the longer term? Do you see there being some sort of deep financial crisis as a result of this? You mentioned, for example, the savings rate in Japan below the age of 40 being very, very low. Do you see there being some sort of savings crisis in developed countries whereby there is a kind of rethinking of the whole financial system, and people are really forced to reevaluate some of these ways that they've been operating through the traditional financial system?
Well, I think the situation is a bit different in the US and in Europe. I think in US, I think we'll see more inflation in even the shorter run. In Europe, I can see a Japanese scenario, but with a much more heterogeneous population. So much more fission happening. Fission is a crisis of conflicts, exacerbated conflicts. I'm not sure it's the greatest place to be in some European cities in the next 5 to 10 years. We have this ongoing polarization, and people just don't, eat it up for much longer. So they will tend to react in a way. I think, and that of course can mean deflationary shocks. So I think the potential is higher for a deflationary shock in Europe than in the US, which is something the elephant in the room no one really assumes. I mean, nowadays the inflation bet is really almost mainstream. It's like, okay, yeah, it's a question of when that will pick up. Almost everyone assumes it'll pick up. But I think, I mean, what you refer to as a crash is rather deflationary shock. It's like suddenly, oh my God, liquidity isn't enough and the business isn't there to keep economic structures going. I mean, it's a potential, and it really makes it hard. So volatility increases basically. So I'd say it's a safe bet to assume that in the long term, even the world currencies will show inflation, which means prices, even consumer prices, should go up, and they won't go up linearly. It will be like shock-like volatility effects, shaking. But I think there's a chance that there are unexpected deflationary corrections there, where suddenly real estate prices, stock prices slid by 40, 50, 60%, something like that. And then, of course, the reaction, we know what the reaction will be. It'll be even more of the kind of monetary policy, which would lead it to a kind of conclusion, which would be modern monetary policy, more or less. So direct monetization. So you have a direct link between basically the fiscal policy becomes the monetary policy. And there'll be an experiment. I think it's just an obvious conclusion of what's going on. And I think, I mean, there is some good in it, that it seems a bit more honest. It seems to be a bit more direct. And I think it may trigger some learning. But of course, it'll be a pricey learning. And learning is something that's usually easy and comfortable. And I think there's really learning necessary. If you look at it in the wealthy countries, in particular in Western Europe nowadays, this pandemic shock for a large part of the population is like, we call it the Corona holidays. It's really just, oh, it's nice, less people on the streets, it's less work, because a lot of people now work just they get part of their income paid by the state directly, and they just don't work, or they just work 20% or something like that. So it's like the large extended Corona holidays, which people are using to renovate their apartments and houses and so on. But of course, it's only the part of population of which the income is not linked to the economy. So they don't see any change in income. Politicians, bureaucrats, and so on, no change in income. It's fine, and it's less work. It's amazing. It's an amazing time to be at. And what one would think, oh my God, I mean, if it's really a shock, it's a supply shock, it's a shock in the division of labor, it's a health crisis. Now would be the time to innovate as fast as possible and really realize, oh my God, a lot of that is just increase in speed of developments that were already there. I need to really keep up going and innovating if I want to have a sustainable economic basis in the future. And that I don't see happening at all. There is so little innovation. Politics is really medieval, I'd call it. And a lot of people around me in Western Europe tend to slow down rather than speed up. They take it as a welcome invitation to just slow down, and it'll be solved sooner or later by those in power and so on. And there, I think we can already see part of those long-term effects. But still, the capital is there, so there's a whole lot of capital. So there was innovation, but it's more and more concentrated. So it's a few companies, a few entrepreneurs who really work a lot now. So the workload increased so much because you see, oh my God, there's leverage going on, there's a change going on, there's opportunities. So I see a lot of people who've never worked as hard as right now, but it's a smaller proportion bearing a larger amount of the leverage value creation. And that, of course, further increases the kind of inequality, which we then look at in the symptoms. And that's another subject we discuss widely in the book, those kind of what the inequality means, what kinds of inequality, and how that can be linked to changes in the economic structure.
So just a final question, Rahim, on what you've just said. So to me, it sounds more inflationary, what you're describing, having people who are on these quote unquote Corona holidays that are taking the same amount of money and still having that potential spending power, even if it's not coming out into the economy at the moment, and producing less as a result. So you've got a fall in output whilst you've got an increase in the money supply. Why is it that you think that this is going to lead to a deflationary shock rather than inflation?
There's a point. It was not a prediction. It's just I'm saying don't be too sure, because there is a higher chance in Europe and other parts where we have pushed a lot in the future of insolvencies. So this kind of it's like economy-wide zombification going on. And of course, the rich Western countries can do it due to their immense government credit and due to the monetization of their bonds. So really, like German, Austrian bonds are the best instrument out there for this kind of field that you look at, which is the assessment of the market, that the default risk is rather low because you have a hardworking population who's willing to pay immense tax loads. But of course, that's not at all equally distributed. So it's really about the people generating the productivity and value. And that's the question, what's happening there? So if there is a shift of insolvencies in really productive businesses, which then, because politics is really bad at the fine steering of it. So it could just, it may be a gap, and we've seen a lot of gaps because even though we have such a lot of government spending, very little of it is digitalized, a lot of paperwork going on, a lot of things coming late. So even though you may know, okay, they'll bail me out, but the money isn't here yet, and I've been waiting 5 months, and oh my God, I need to really pay, or I'll had to leave the premises, or I lose my employees, and so on and so on. So it's those kind of gaps and misalignments that may have an increase or sudden increase, explosion of insolvencies. And then, of course, a lot of it is leverage, credit leverage, that then goes to the banks, and the banks have those assets at the right or wrong time. It's like when we see the impact in retail demand, for example. We see the, impact in retail real estate, for example. A lot of retail stores and offices and so on will be shut down permanently. I'm pretty sure about that. And it's only not having an impact right now because of this artificial monetization of real estate and because it's kept alive in a zombified way. But it could be that it's just at a moment in time, it's so much happening at the same time that you have these huge corrections in value. Like banks have liquidity issues, then they have to throw the retail real estate on the market and so on. And it's like, that's deflationary. It means the broad money supply may go down much faster than the base money supply can be translated in government spending to fill up the gap. That's basically what's happening. So if for bad coordination among European nation states, for example, what we see right now, really the European Union is a huge failure. If the idea was to coordinate national governments in having a better outcome for everyone. And it's just for that reasons, bad coordination in monetary policy, in fiscal policies, in economic policies, and then these kind of postponed correction processes, in particular in the visible parts of the economic structures, retail, tourism, and so on. So that could be there's a gap. And of course, in the long term, it's pretty obvious that the purchasing power of the euro must go down in almost every asset you can look at. But in the short term, there could be something surprising. So I would just a kind of warning for the investor. Bear in mind, there's a possibility that even the euro exchange rate may go up, that even bonds may go up, that yeah, I mean, you can't tell. There is a possibility that maybe euro cash in a bank or in a safe box could be a good investment, yeah, if you can take advantage of prices and so on. But I think that'll be short term, because of course there's only one possible political reaction to it, and of course do everything it takes to avoid that kind of correction, because you have over leveraged governments and entrepreneurs, and that of course is just then having an even larger postponed inflationary pressure happening.
And presumably you'd think that having that deflation would actually be good for the economy, because it would allow some of these zombie companies to be liquidated, allow their personnel and their capital to be redeployed in other ways. So is that the case? And do you think it's just sort of political short-termism that's preventing that sort of wider readjustment happening that could be more healthy for the economy?
Yeah, there are two things. Of course, price corrections in mispriced assets are great, but that's linked together to this increased correlation of the economy. So a deflationary shock is a shock to most economic actors, and that's not a good thing. So you should never take that very down-to-earth analysis of the Austrian school, that of course having more honesty in pricing means that we are happy for prices to go down to reach the right alignment with the preferences of the people, meaning that we are cheering onto a deflationary correction of an artificially inflated structure, because the question is always, can you learn from that correction? And that's not as obvious, because you have an artificially increased correlation. So it's like businesses that are on the right side and have the right long-term decisions are affected, and they have to shut down, and then you lose out of that capital as well, of course. So I would take a differentiated aspect, and I don't think it's a good sell to say you're cheering this kind of potential corrections, because they are not the only part correction of particular businesses and prices. They are over corrections of expectations, I'd say, and that's a symptom of a lot of bad things. Of course, most of those happened in the past and were just not seen, but still, they are symptoms of bad things. So bad things happening to people, and not so sure that they take the right conclusions. But it's a part of a positive side effect, we'd say. Yeah, if that could then work out, which I don't think, that it'll be let work out, that you say, okay, well, now I realize I can't sell that retail space for more than half a year, so I gotta lower the price, and some more innovative entrepreneur comes in and says, oh great, now finally I can have in the highly valued urban locations, I can do something really innovative than just opening another franchise of another luxury brand and so on. But I don't think that will be allowed to run its course. So you just have the shock value in it, and even aligning more people behind this alternative, less kind of policy. So I'm not too cheering about those shocks, but I think they'll just be a sign of future shocks. And generally those shocks are good or better the earlier they come, because they show you that you have had a wrong estimate about the future. You've anticipated a wrong future but I think we have seen plenty of shocks in Europe and around the world. Shocks is always something surprising, and we had a lot of surprising things, and it seems like the interval between bad surprises becomes smaller and smaller, and I think that's just one of the part. I mean, the investment financial market is just one part of human existence, and I think it's quite insightful to look at all other parts of our existence and see where there may be potential corrections of wrong appraisals, of wrong ideas we may have, and there's a lot of need for that. Yeah, but it's really, I think the most value is in anticipating that and being prepared to that and building alternative structures, which potentially may be an answer, then just call for the crash and expect the crash and wait for the crash. A lot of people have been waiting for big crashes for their whole life, and that's really sad. I wouldn't advise to do that.
Okay, well, that's all really fascinating stuff, Rahim. It's interesting to go a bit deeper into this concept of negative interest rates. As I say, seems quite technical, but you've really outlined there a lot of the ways in which it affects all kinds of economic relations, but also on a deeper level, affects the way in which we learn, it affects the incentives that we give to young people, and it creates these strange distortions in society. So it's really valuable to have your insights today.
Thank you.
So if people want to learn more about you, more about Scholarium or the Free Cities Institute that you work for, what's the best way that they can stay in touch and find out more?
Yeah, really, most of my writing and research is in German. It's a big, I think, very interesting and important part of the world. And of course, you take your leverage where it's more, we can do the most good, I'd say. And to my surprise, I'm the last remaining Austrian economist teaching Austrian economics at Austrian universities and trying to keep it alive. So I think the leverage is much higher and focusing on that. The Free Private Cities Foundation is a global endeavor which is based in Switzerland. So if someone is interested in really taking the conclusion and on the political side and the potential alternative futures of different ways of living together, different ways to foster innovation and good entrepreneurship, I think it's really the place to be and look at. There are different terms for that field. I think it's a very fascinating field that's coming up. And I think it's a very closely linked to the Western tradition, this idea, if something is not working, you know, think about maybe you'll start a new city, maybe you try something out new, and it seems very crazy nowadays. It used to be something very obvious to do. And that's what we do with the Free Private Cities Foundation. So have a look at that. That's in 7 languages, I think, available, the material we have there. And if you speak German, we are interested in that, look at scholarium.at. Check out the books. I've written more than a dozen of books, but only a few have been translated to other languages. And I think you discussed already 2 of them. Yeah, I think I'll be more, every now and then I do lectures in English at events, but due to the pandemic, of course, the events have gone close to zero and the traveling has gone close to zero. So there's even more focus now on the local. Yeah, that's a bit sad, but I think times will change again.
Great.
So thanks a lot. It was great talking to you.
Okay, yeah, thanks for that, Rahim. Really great conversation. And thanks for your time today.
Thank you. Bye-bye.